Good morning, everyone. Happy Friday, and thank you for joining us for this very timely conversation about navigating turbulence in the markets. And can't think of anyone better to have this conversation with than with Fabiana here. So from Middle Eastern conflicts to U.S.-China trade tensions, this year has been just rife with uncertainties and a lot of turbulence. And it's difficult to pick any one place to start. So I figured to set the mood, we'll start a table setter of a question about the year. So given all these uncertainties and so many conflicts that have just been rattling the markets, Fabiana, how would you characterize this year, and how does it compare with other years that you and your team have had to navigate, compared to other years of uncertainty that we've been facing recently?
Hi, Stephanie, and thank you for having me here. So you're talking to someone who was an internet analyst on the sell side in 2000. So I've seen my share of stocks bombing out and markets coming down and having a way to reset. And obviously the global financial crisis, we're nowhere near there, but it has been a really eventful year. So if you think about it, you've had the conflict in the Middle East, you've had a new Democratic candidate, literally a last-minute choice. You've had a few assassination attempts on the other candidate. You had also very structural trends. Think about AI, which is, it's something that is going to carry us for the next years. So there has been a lot happening. Look at the market in Japan. Not sure how many of you follow that market, but at the beginning of August, it had a 3-day 20% drawdown. That was the third biggest spike in short-term volatility in Japan in 50 years of the market. Only the Lehman and earlier in 1987 were the two other spikes. So the other thing that is happening in this market is that whether it's because it's more easy to access, particularly equity markets, even more so than fixed income markets, you have bigger spikes you've ever had in the past. You can call them challenges or opportunities, but it's undeniable that they are happening. And obviously on the fixed income side, we're always used to seeing fixed income as an extremely boring but safe market. I mean, you look at the MOVE index, it's anything but boring.
Absolutely. And you pointed out one of the biggest global stories of the year, which is the Middle Eastern conflict. And I want to get your thoughts on how your team has been navigating these dramatic swings in commodity prices and just the overall, how you're hedging your portfolio against the uncertainty stemming from that conflict.
So the interesting thing, I still remember in October, just the day after the conflict started, I actually was on a live TV interview and I was being asked if I was hedging my whole portfolio, was getting out of the market, it was Armageddon coming. And at the time, our thought was, it is a terrible conflict because so many are going to be, unfortunately, affected by it. But from a global market standpoint, we just didn't see the contagion. We thought that it was quite contained. And in fact, if you look at equity markets, if you would have left equity markets in October, you would have missed a big rally. It is changing now because obviously Iran is now more involved. But again, you really have to think about the tail risk. So the biggest input, if you want, or the biggest impact of what could happen is really on oil prices. And then from there, like going through everything else. But the truth is that the only event that could affect oil prices significantly is a closing down of the Strait of Hormuz. And if that happens, and it either happens or it doesn't happen, you could see significant spikes in oil prices. I mean, you could see oil price probably go well over 100, possibly 200, who knows? But there you would see a big intervention from everyone because it would be so impactful. And so for now, we're not positioning our portfolios for that, besides the fact that we have a bet on some of the oil majors, which would work anyways, because these are companies like, with high cash flows, companies that are paying back dividends, that are having stock paybacks. And so we see that as a trade that would work in other situation. But for the rest, even thinking about trying to hedge with the longer end of the yield curve, there are other things that are going to impact it, including the results of the election. So it's really difficult to say. I'm just out there on the longer end of the yield curve because I want to be positioned defensively, and then something else can actually affect it.
For sure. And of course, the Middle Eastern conflict is not the only one influencing the markets and the energy sector. We also have the ongoing conflict in Ukraine since Russia's invasion. And I was wondering, has this triggered a conversation with you and your team about, because I know this has triggered conversations about shifting the reliance away from Russian gas. Has this shifted or influenced how you view the energy sector or energy transition names? What are your thoughts about this broader conversation about energy we're having in this conflict?
So I actually think that what has happened with Ukraine has shifted the world's way of thinking about markets, because it is clear that we have to diversify our sources of energy. And so renewables don't become only a, let's do good for the future, but become a strategic choice. And actually, one interesting point to make about Ukraine is that there is a big push for Ukraine to possibly become the next green steel maker in the world, because obviously their facilities are next to nothing at this point in time. There is a need to abate in the steel industry. And so most likely there will be billions spent on creating this new steel industry there, which could, by the way, affect other existing players elsewhere. But the other interesting thing is, by the way, we're talking about this trade of arms. We all talk about oil, but a big part of the LNG carriers go through that strait. So it would affect the gas price too, which obviously means that this run to diversify on renewables will continue.
Absolutely. And shifting from conflicts to trade tensions for a bit, or just looking at a broader trade picture, the trade tensions between U.S. and China have flared up again in recent months. And I want to get your thoughts on a strategy, or whether you and your team are moving away from sectors that could potentially be hit with new tariffs, or has this prompted you to shift away from certain geographies in light of these new headlines here?
So this is really interesting. Has anyone noticed the timing of the stimulus of the Chinese government? How close it is to the US elections? And not only that, but they have kept saying that the final numbers of the stimulus will be decided at the National People Congress, because that has the power to legislate. Well, guess what? They just announced that they're going to move the National People Congress date to after the US elections. So what is happening in China right now is pretty much a response to, let's check out who is going to win. Let's see what the rhetoric is going to be once the first new winner comes in. And then we're going out possibly with a big bazooka. We have actually continued to invest in China, and that has been controversial. I still remember recently we launched a strategy in China, and one of our big competitors actually decided to exit China from its investments. We ended up in the same article, of course, and so there was a big debate about that. The truth is, you can't ignore China. I mean, it is the second largest economy in the world. It is huge. Yes, it's running at a much lower pace than it used to, but it's still a high pace from a worldwide standard. So what we have done, however, in preparation of the tariffs, we've tried to understand where really these tariffs could hurt. And the interesting thing is there's so many Chinese companies who were caught off guard in 2017, which have completely changed their sources of supply and also their export markets because they were expecting at some point more tariffs coming in. So many of the Chinese companies that used to be exporting mainly to the US are now exporting to other countries. And it's not even intermediate goods, it's just final goods being exported somewhere else. I think data shows that a big part of the goods that were moved from China that used to be exported to the US that have been going to Mexico, a big part of those ones actually are consumed in Mexico. So this is not like a way to try to, go around the back door of sanctions. So we continue to invest in China. We are, however, very aware that companies have to be well positioned for what's going to happen with tariffs. But obviously, if then we have a tariff of 10% on every single export for the rest of the world, that is different. Everyone is going to be impacted.
Absolutely. And you mentioned the U.S. elections there, and those are just around the corner. And we're in the newsroom, we're talking about how this influences how we cover the markets, what the impact of the markets. I want to get your thoughts on conversations you and your team have been having about what changes to the portfolio you've been making, whether we're expecting a Kamala Harris administration or a Donald Trump administration. Are there any key differences there? And if so, can you go into a bit of detail on how each approach looks given these two candidates here?
Yes, I think Kamala and Donald are very different in so many different ways. So first and foremost, we haven't made any overall market bet because the truth is, if you look at the data, equity markets in the US and in general actually do well either under a Republican or a Democratic administration. I think the difference of a Democratic administration is 0.5% lower than a Democratic administration. However, the big difference will be what happens to Congress. Obviously, divided Congress means less policies will be able to be implemented. And the truth is, why you want a country being governed, possibly the best results would be a president with a divided Congress for markets. That's how they would see it more positive. But we don't think that there will be an overall market impact, apart from some jitters at the very beginning. You remember what happened in 2017. We had the first crash in a few hours, and then the market went up again, or 2016. However, we are obviously looking at what is underlying all of that. And the truth is, it's not much, because we have seen a lot of sectors do fairly well also under the Biden administration. But what we've had is that there is a tendency of to regulate more. You've seen, actually, I think the Biden administration has the highest number of regulations of any other administration out there, whether Democratic or Republican. And so we've been looking at that, where it can get hurt. Obviously, financial sector regulation, but the truth is the financial sector will continue to run on rates and the health of the economy. So there is something that is overwhelmingly there. The healthcare sector would probably be an area that, in case of a Harris administration, would get some negative repercussions. There are talks about pricing cuts, but again, this would need also support from the Congress. So it's really what's going to happen to Congress that is going to be evident for that. So we're being very careful when navigating the healthcare sector, but we still see interesting areas. For the rest, the fiscal policy is going to be the big thing. What's going to happen at the long end of the curve? You're possibly talking about a $5 trillion deficit if Trump goes ahead with the policies that he's been talking about, possibly less than $2 billion with a Harris administration. Again, that all depends on Congress. So I think what will probably end up being volatile is the long end of the yield curve.
Absolutely. And this year has been defined by a lot of complicated events all occurring at once, and investment advisors and portfolio managers have had to navigate this every step of the way. So do you have any advice for portfolio managers or market watchers, many of whom are likely in the room right now with us? Any advice on how they navigate this or how they advise their clients? And is there such thing as a foolproof portfolio that can bend to all of these shifting winds here?
So there's something that is happening right now in markets that needs to be taken into account when you invest. And that is the fact that the overall market seems to be extrapolating long-term expectations from a single data point. So, labor numbers are good. The economy is fine. The Fed is not going to cut. Labor numbers are bad. The economy is going to cut. The Fed is going to cut. By 50 and again by another 50. So there is this almost, I actually have not seen it. This is the biggest difference between this market and, my 25 years plus in markets. There's almost certainty every time a new data point comes out. And this is creating these twists and turns, right? Which you can consider as opportunities, but there could also be some big hurdles. So I think right now, when you're looking at the market, there are three things that you really have to think about. The first one is your time horizon or your client's time horizon, because some of these things can be great opportunities from a longer term perspective, but probably high volatility in the short term. The second one is you really need to understand what the expectations of the market are. 50 basis points cut, I'm sure you all know, but the short end of the curve didn't move, the long end sold off. Would make no sense, right? But we had such a big run just before that. Expectations were so high that has really meant that everything was already in the price. And you really have to make sure that these expectations are baked into your next moves. So don't think about what is about to happen, but think about how the market is pricing it. And then the last thing that kind of depends on the first two is what's structural and what is not. We're talking about the Strait of Hormuz. If it happens, you would expect it to be terrifying, but possibly not long-term. If it is long-term, well, then, all bets are off. Or if you're thinking about some of the data that is out there, what is really going to help your portfolio or hinder your portfolio long-term from a structural standpoint to a short-term standpoint. To give an example, we keep on getting some really good numbers on the consumer in the U.S. You've seen retail numbers yesterday. I mean, they were great. But at the same time, Amex also reported fantastic. It all looks great. But at the same time, you see that auto loan delinquencies and credit card delinquencies actually the highest level after the GFC. So you're at this point where there's so many contradicting factors that you really have to think of the long term. And the long term is going to be determined by two things. One is what happens with inflation. The second one is what happens with the economy. And the U.S. here is, even if you're thinking of investing somewhere else, the U.S. here is obviously the biggest, the biggest focus point, because whatever the Fed does will influence the rest of the world. So what we are doing right now is we're being very tactical with our investments. We actually just came out with a recent quarterly that we have entitled Vol Agility. Now you get a bunch of 40-year-old and early 50-year-old portfolio managers, and you ask them to come up with a nice, catchy title, and this is where you get to. And not only that, but they're then high-fiving each other that they think they should patent it. So, but that's my problem with my team. But the point there was, okay, let's figure out what is happening in the market right now. And in July, we said, well, for the first time, we were seeing equities actually being weaker potentially ahead than fixed income because there was a weaker economy, particularly in the US. There were some weaker data points. And also because we thought we were at the start of a rate cut cycle. That call lasted less than 3 months, because by the end of last quarter, we realized that data was getting stronger than expected. And there were so much already expectation baked in the movements of fixed income that we turned around and said, okay, we've got to be more balanced now between equities and fixed income. So this whole thing to say, right now, you have a lot of unknowns. To us, a balanced fixed income equities allocation, it's what really is going to help you out. The other thing is think about the long-term structural themes. Think about things such as infrastructure. We're going to continue to invest in infrastructure. Think about stuff like innovation, AI, ups and down. ASML says that some of the chips, some of the equipment sells, some not. But the truth is AI, when you look at the numbers of companies out there, that is still a strong theme. I think also about climate. Whatever happens also with the Trump administration, climate will continue to get investments from companies, as not from governments. So I would be more structural in my investments right now than try to put on any hedges that, frankly, could mean simply wasting money because some of the movements would be just short end. One thing that has helped us a lot is to have a macro tactical allocation strategy that looks at any kind of behavioral changes in the market, because this is a market of animal spirits. I mean, let alone China, you've seen what happens. The same Japan went down 20% in 3 days. By the end of the month, it was actually higher than where it had started. So these are markets where if you have a good tactical asset allocation, both on the fixed income side and on the equity side, you can really utilize the behavioral biases that you see out there and put in a contrarian trade.
For sure. Yeah, there's a lot in there that we can all learn from. And speaking of learning, and we've got a few minutes left on the clock, but I want to get a sense of what you've learned. What's the biggest key lesson you've taken away from this year and all the uncertainties, and or has anything surprised you from this year?
Many things have surprised me, but then many things surprise me. Every year, whether it's a COVID or where it's whatever else. I think the biggest lesson from this year is that looking at behavioral biases in the market actually can do very well for you. You have to be quick. So that's the other lesson. Look at some of the reactions of the market and then be fast in reacting to them. And then also that we really don't know anything, because you tell me if you would have expected some of the events and also some of the reactions, for example, from the Fed. So try literally to look over the short-term period and and think about what is structurally changing in the market.
Absolutely, yeah, and that's there's been so many surprises for us in the newsroom, and it's difficult to actually see this horizon looking forward. Yeah, it's been a very interesting year, and I think that that kind of really ties it all together right there. And since we have a couple more minutes, going to ask you to pull out a crystal ball. Is there any thought of what the rest of the year will look like as far as markets?
As long as data stays strong, equities will be supported. Macro data needs to stay strong. Fixed income to us, at some point you're going to have weakening numbers. You start to see underlying signs again, such as delinquencies, such as, for example, one of the data points that we had been looking at were state level jobs rather than looking at the aggregate jobs in the US. So for now, we see equities well supported for as long as data points are strong. We see actual opportunities outside of the US and outside some of the larger markets. We still see Europe has a terrible macroeconomic scenario, but some of the companies are still doing very well. So we're getting far more granular in what we do in terms of where we invest. We still like Japan a lot. So we really try to look beyond the bigger numbers or the bigger markets. On the fixed income side, it appears fairly logic to logical to think that at some point these numbers will turn around, the economy will get much weaker. And so into next year, we should see some fixed income pricing turn around.
Absolutely. Yeah. The long time horizons, act quickly when there's changes in the market. This all sounds like really helpful advice and way to approach the end of the year. So I really appreciate all your insights and thank you so much for joining me in this chat. And thank you all for taking part and hope you enjoy the rest of the day. There's going to be a lot of exciting sessions out there.